Alright, economics gladiators, and welcome back to Boss Economics World, the only place on the internet that treats the global economy like the high-stakes, often absurd, reality show that it is. Today's episode is a journey, a trip in a time machine, if you will. Our destination? The not-so-distant future of October 1st, 2025. The leaves are turning, pumpkin spice is everywhere, and the Federal Reserve is sweating more than a trader on margin call. Why? Because the ghosts of trade wars past are back to haunt the Fed's Halloween party, and they brought their scariest friend, radical uncertainty. Our story begins with a dispatch from the heartland. Austin Goolsbee, the head of the Chicago Fed, a man whose district is basically the engine room of American manufacturing, just sent up a flare. Speaking at an agricultural conference, he dropped a line that should send a chill down the spine of every CEO, investor, and worker in America. He said businesses are entering an everybody just put your pencils down kind of a moment. Pencils down. Let's unpack what that beautifully simple, terrifying phrase actually means. This isn't just your high school teacher ending an exam. This is the sound of the American economic engine grinding to a halt. It's the sound of a factory expansion plan being shredded. It's the silence where the confirm order click for a new fleet of trucks should be. It's the sound of capital going into hibernation, waiting for the policy winter to end. And what's the cause of this sudden economic frost? Surprise, surprise, it's a new wave of tariff announcements from the Trump administration. Yes, in our 2025 scenario, the tariff playbook of 2018 has been dusted off for a sequel. New levies on heavy trucks, lumber, kitchen cabinets, the very bones and sinews of the real economy. Today, we're going deep. We're going to dissect this situation from point to surface. We'll start with the pencils down paralysis on Main Street, move to the impossible, three-headed monster the Fed is now facing, and finally, we'll zoom out to the existential threat that's looming over the entire system, the slow-motion assassination of central bank independence. Let's get into it. Goolsbee's pencils down moment isn't some abstract academic theory. It's a real, tangible, and incredibly costly phenomenon. When a government makes economic policy via tweet, when tariff rates and implementation dates are as predictable as a roulette wheel, businesses don't just get nervous. They stop. Full stop. Why? Imagine you're the CFO of a major furniture company in Michigan. You're planning a $50 million factory upgrade to produce a new line of kitchen cabinets. Your supply chain is a global symphony, hinges from Germany, drawer slides from Austria, and high-quality plywood from Canada. Suddenly, the White House announces a potential 25% tariff on lumber and a 15% tariff on certain metal components. What do? Your entire cost model is now a work of fiction. That $50 million investment could become a $60 million black hole. Your projected profit margins? Evaporated. Do you sign the contracts for the new machinery? Do you hire the construction crews? Of course not. You put your pencil down. You tell your board, we're in a holding pattern until the chaos subsides. Now, multiply that single decision by tens of thousands of businesses across the country. That's what Goolsbee is seeing. The new tariffs on trucks hit the entire logistics sector. Tariffs on lumber send shockwaves through the housing market, which was already grappling with high interest rates. It's a self-inflicted supply-side shock. And here's the kicker, we don't have to imagine this. We have the receipts from the last time this movie played. A landmark 2019 study by Federal Reserve economists Aaron Flahan and Justin Pierce found that the 2018 to 2019 tariffs led to relative declines in manufacturing employment and relative increases in producer prices. A National Bureau of Economic Research paper by Amity, Redding, and Weinstein concluded with brutal clarity that the full cost of the tariffs was passed on to U.S. consumers and firms. Spoiler alert, Mexico didn't pay for the wall, and China didn't pay for the tariffs. American importers and, by extension, American consumers did. The most insidious effect, documented by Stanford's Economic Policy Uncertainty Index, was the spike in uncertainty itself. During the height of the 2018-19 trade war, the index measuring trade policy uncertainty skyrocketed to levels 10 times its pre-2016 average. That uncertainty acted as a massive tax on investment. The very investment we need to boost productivity and create high-paying jobs was put on ice. So, in 2025, we're seeing déjà vu. This isn't economic strategy, it's economic vandalism. It's throwing sand in the gears of the market not to fix a problem, but to create political theater. And the person who has to clean up the mess is the one with the world's most thankless job, the chairman of the Federal Reserve. This brings us to the heart of the crisis. The Federal Reserve, by law, has a dual mandate, stable prices and maximum employment. But these tariffs have created a third, phantom mandate, navigate the chaos of unpredictable trade policy. The result is what I call the Fed's impossible triangle. Let's break down the impossible situation this creates for Fed policymakers. Corner 1, the weakening labor market. Goolsbee notes a low hiring, low firing environment. Hiring has slowed, and the unemployment rate has ticked up. Fed Vice Chair Philip Jefferson, speaking all the way from Helsinki, says the risks to employment are tilted to the downside. This makes perfect sense. The pencils down moment means companies aren't just delaying investment, they're delaying hiring. Why bring on new staff when your entire business plan is up in the air? This slowdown in the labor market screams for a policy response. The traditional tool? Cut interest rates to make it cheaper for businesses to borrow, invest, and hire. Boston Fed President Susan Collins even hints that additional rate cuts may be appropriate. Corner 2, persistent, nasty inflation. But hold on. At the exact same time, the Fed is facing an inflation monster that just won't die. In our 2025 scenario, inflation remains above the 2% goal and has accelerated since April. Jefferson explicitly states the risks to inflation are to the upside. Where is this inflation coming from? First, the tariffs themselves are a direct, inflationary shock. A 25% tax on imported goods doesn't just magically get absorbed. As we saw from the 2018-19 data, it gets passed right on to consumers. Suddenly, your new Ford F-150 costs more. The renovation of your kitchen costs more. The price of a new house costs more. Even more worryingly, Goolsbee flags an increase in services inflation. This is the really sticky, stubborn kind of inflation. It's not just the price of a used car or a gallon of gas, it's the cost of a haircut, your rent, your car insurance, your doctor's visit. This type of inflation gets embedded in wage expectations and is much harder for the Fed to control. For context, even back in mid-2023, while goods inflation had cooled dramatically, the core services ex-housing CPI was still running hot, proving just how persistent it can be. Goolsbee is rightly concerned that the tariff shock isn't just a one-time price bump, it could be pouring gasoline on this already smoldering fire, convincing businesses and consumers that inflation is here to stay. This inflation picture screams for the opposite policy response. The traditional tool? Hike interest rates to cool down the economy, reduce demand, and bring prices back under control. Behold, the trap. The Fed is now staring down the barrel of stagflation. It's the economic equivalent of being sick with a fever and the chills. The economy is stagnant and employment is weakening, but prices are running hot. If they cut rates to support the labor market, they risk letting the inflation genie out of the bottle for good. This would erode savings, punish retirees, and could lead to the kind of wage price spiral we haven't seen since the 1970s. If they hike rates to fight inflation, they risk tipping the fragile, pencils-down economy into a full-blown recession, throwing millions of people out of work. The inverted yield curve, a historically reliable recession indicator, would likely be screaming bloody murder in this environment. This is the impossible triangle. The tariffs are simultaneously a tax that slows the economy and a price shock that fuels inflation. Monetary policy, which works by managing aggregate demand, is a sledgehammer. It is fundamentally ill-equipped to solve a problem created by a chaotic, self-inflicted supply-side wound. The Fed is being asked to perform surgery with a wrench. If this toxic economic cocktail weren't enough, there's a deeper, more corrosive problem at play. Goolsbee hints at it when he says he's uncomfortable with the idea of getting rid of Fed independence. Let's be crystal clear about what this means. For decades, a cornerstone of stable, successful, modern economies has been the principle of an independent central bank. The idea is simple: the people who control the nation's money supply should be insulated from short-term political pressure. Politicians, by nature, have a very short time horizon, the next election cycle. They will always be tempted to pressure the central bank to slash interest rates and juice the economy right before an election, even if it leads to ruinous inflation down the road. An independent Fed is the adult in the room, the designated driver at the economic party, whose job is to take away the keys when the politicians have had too much to drink from the punch bowl of cheap money. Goolsbee's warning is not hypothetical. He says, go look at places where that's what happens and see what the outcomes are. So let's look. Exhibit A, Turkey. President Erdogan has for years championed the unorthodox and economically illiterate view that high interest rates cause inflation. He has systematically fired central bank governors who dared to defy him and raise rates to fight soaring prices. The result? The Turkish lira has collapsed, losing over 90% of its value against the dollar in the last decade, and inflation has repeatedly surged to catastrophic levels, peaking near 85% in 2022. The savings of a generation have been wiped out. Exhibit B, Argentina. A country with a long and tragic history of political interference in its central bank. The result has been a century of chronic hyperinflation, sovereign defaults, and devastating economic instability. As of 2023, its annual inflation rate was well into the triple digits. Academic research overwhelmingly supports Goolsbee's caution. A seminal study by economists Alberto Aleixina and Lawrence Summers found a clear and strong negative correlation between central bank independence and inflation across developed countries. The more independent the bank, the lower and more stable the inflation. In our 2025 scenario, the Trump administration, frustrated that the Fed isn't cutting rates to offset the economic drag of its own tariffs, is floating the idea of stripping the Fed of its independence. This is the economic equivalent of threatening to remove the referee from a football game because you don't like his calls. The game descends into chaos, and nobody wins. This political pressure puts the Fed in an even more impossible position. Every decision they make will be viewed through a political lens. If they hold rates steady, are they doing it to fight inflation or to defy the president? If they cut rates, are they caving to political pressure or genuinely trying to save the labor market? Their credibility, their most valuable asset, is being systematically dismantled. So, what does this chaotic 2025 landscape mean for you? For the investor, this is a code red environment for volatility. Pencils down means risk off. Corporate earnings will be under pressure from both slowing demand and rising input costs. The smart money will be de-risking portfolios, likely fleeing to the relative safety of short-term US Treasuries, despite the inflation risk. Gold, the classic chaos hedge, would likely see a massive bid. Sectors most exposed to tariffs and international supply chains would be toxic. This is a stock picker's nightmare and a macro trader's paradise. But for the average person, the stakes are far higher than a number in a brokerage account. This isn't just a game for Wall Street. The tariffs mean the cost of everything, from the lumber for your new deck to the truck that delivers your groceries, goes up. It's a regressive tax that hits working families the hardest. The Fed's stagflation trap means you're caught in the crossfire. Your mortgage and car loan rates could remain painfully high to fight inflation, while at the same time, your employer is freezing hiring and maybe even thinking about layoffs because of the economic slowdown. Your wages buy less, and your job security is gone. It is the absolute worst of all worlds. The ultimate takeaway from this glimpse into 2025 is this: the problem isn't just a specific tariff on lumber or a particular interest rate decision. The problem is the weaponization of economic policy for political ends and the resulting cloud of radical uncertainty. We are asking the Federal Reserve to conduct a symphony in the middle of a hurricane. They can be the most skilled musicians in the world, but their performance will inevitably be drowned out by the noise and chaos created by policymakers who are smashing the instruments and rewriting the score on the fly. Goolsbee isn't just being a worried economist. He's a firefighter telling you he sees smoke pouring out of the engine room of the entire economy. The question for 2025, and indeed for today, is whether anyone is listening, or if we're all just going to keep putting our pencils down until there's nothing left to write. Smash the like button if you think the Fed's job is the most impossible job on the planet right now. Drop a comment below: is a 1970s-style stagflation comeback inevitable, or can the central banking Jedi navigate this mess? And for God's sake, subscribe. Because in this economic madhouse, you need a guide who isn't afraid to call it what it is. Stay sharp, everyone.